So the guys who look at earnings and say, wow, this miner's making a lot of money at 50 bucks last year. Golly, gee, that's really good profit. Because remember before when we were at 50 in 2011 and 1980, you collapsed from it quickly. You didn't stay there. So you never got an average price up there. This time they had an average price in the fourth quarter of 50 bucks or so. Wow, so the earnings have to look real good. Imagine what they look like if this quarter has an average price either side of 100.
Looking at the miners, right? So the miners sold off significantly. Many of them just got pummeled. And I'm thinking, okay, well, they're producing, they're getting the metal out of the ground, they're selling them at these current high prices, and they're factoring in like the all-in sustaining costs. It varies for the different metals. But I'm thinking like, okay, people are selling these miners are going to be, raking in the cash, and so, I was kind of wondering about that. What do you think about the miners?
I think we favor the miners over gold, and there's a level, though, that we haven't broken through yet. What we do is we measure the XAU index, which is the Philadelphia Gold and Silver Index, but it's miners, okay? It goes back to the 1980s, so you got some history on it. We plot it in its relationship to an ounce of gold. And if you do, and you go back to look at 1980s, 1990s, 2000, until 2008, for several decades, if you divided XAU into an ounce of gold, you'd end up on average, above and below, a range of 25%. It reached up to 35% at one time in its lows during this multi-decade period, when you plot the charts like a box, okay? We're in the 17-18% level. You broke through that in late 2008, and you collapse that spread, meaning the value of the miners to what they get out of the ground, okay, to 4%. Now think about that. Something that had lived in an average price versus the thing it gets out of the ground, gold or silver. It went to 4%. We don't need miners. We need gold, silver. We don't need the miners, right? Okay. That chart is screaming at you, hey, you think I'm going to go to zero? And so since 2014, you can plot a range on that same relative performance chart. Beautiful little box. And it's like from 5% up to 8 plus, 5% up to 8 plus, 5% up to 8 plus again, intra-month, last month. Right now it's back below 8%. But if you get much above the top of that range, and we think this third assault on the upper end is probably the one that's going to break out. So it didn't break out last month. But you get up above the top of that little box. Again, visualize that as a chart. When you break out above that beautiful technical range, there's nothing to stop you, technically speaking, in terms of the value of the miners to the metal they get out of the ground, until you get up to 17 or 18%. Which is to say, to go bump the bottom of the floor that had existed for decades. So you go from, boom, you could double the miner's value relative to gold. And I strongly suspect that's about to occur and will show itself this year. And probably the breakout I'm expecting next month or so of that spread. And when those spreads break out, like the silver did back in the November close, look what happened to net price over the next 2 months. It went berserk. Expect the same from the miners. So you're right, And there's 4 miners coming up with silver miners coming up in the first 2 weeks of February with earnings for the biggies. That report will be based on what? Fourth quarter, right? Okay. Go back and look at a silver chart. Where was it during the last quarter of the year? So, that's what they get out of the ground, therefore their profits are, et cetera. Average 50 bucks, okay? Somewhere either side of 50. Right now, so far in the first month, our average price is, well over 100 average price now I'm talking. And if we stabilize here and then sort of work our way back up so that February and March we're back up toward 100, 120 again, then your average price for the new quarter is going to be about 100. Okay, double what it was before. So the guys who look at earnings and say, wow, this miner's making a lot of money at 50 bucks last year. Golly, gee, that's really good profit. Because remember before when we were at 50 in 2011 and 1980, you collapsed from it quickly. You didn't stay there. So you never got an average price up there. This time they had an average price in the fourth quarter of $50 or so. Wow, so their earnings have to look real good. Imagine what they look like if this quarter has an average price either side of 100.
Yeah.
So if you're looking at that as a factor, whether you should tell your clients to buy silver miners or gold miners, you don't have any excuse now not to say yes, based even on the fourth quarter earnings, much less what looks like could be evolving for the first quarter. You get the point. Yeah, there's a fundamental reason, too. They're underpriced in relation to that which they get out of the ground.
Yeah, for sure. Yeah, I've been definitely scooping up some miners over the last couple of days and such. I do think that there's a lot of opportunity there. And so are you, I mean, obviously not every miner's going to, outperform or whatnot, but do you see like this, I mean, because the metals, they ran first, they typically run first. And so doesn't the metals usually lead and then the miners typically?
Yeah, I think the reality will hit people. And a lot of people don't like to invest in, let's say, silver futures or call options on SLV or, they just want to buy miners. It's a stock in their stock portfolio, and they're haunted by certain memories that are false and also brief, like that 2008 collapse in the miners, which happened to concur with the S&P that month. But at that point in time, the miners, relative to gold, were actually breaking down on that spread relationship I talked about, where for 3-4 decades they'd been average 25%. Well, in September of 2008, they broke below the bottom of that whole multi-year performance range versus gold. This time it's just the opposite. They're cheap in relation to gold. They're cheap in relation to the stock market. They're cheap in relation to everything. And people have just been dismissing them. And yet when you look at the earnings based on, what's the average price of silver last quarter? What's the average price of silver now this quarter, or gold? How can you dismiss them? Well, finally, portfolio managers and the financial planners and so forth will have to say, yes, Mr. Jones, you're right for asking me about the miners. I kind of agree now. You can put that in your portfolio. Why? Because the earnings look great. So there may be a whole new wave of public buying. That's what I'm saying. Like especially when these next earnings reports come out for the miners in February, that start to turn heads. And if anybody does a relative study of miner value to the metals, geez, it's ridiculous. You want to buy cheap? Buy cheap.
Yeah. I think which all-in sustaining costs, I mean, it doesn't have, it's not perfect, but because there's a lot of different factors. But I believe for silver, it's between 20 and 25 for many of the larger producers. And then also, I think gold is around 1,700, 1,700. And so just thinking about how elevated the price of the metals are, and the longer they stay elevated, the cash is just going to be just raking in, So
Well, especially if they find out that this break was not the top and you start firming back up and all of a sudden people say, gee, I wish I'd bought the break. That's when they're going to realize, no, the miners aren't going to collapse either, and they're still undervalued. And what we're watching is that technical relationship, because it's very clear, very definable. And when we get a breakout over the top of that 11-year wide technical range on the performance chart, it says miners are going to lead, and probably with a sucking sound on the upside very rapidly. And it, in part, public appreciation because people looking at earnings, a lagged metric, but still fine,